Hi, I'm Max Keiser. This is the Keiser Report. So much to get to. Let's check in with Stacy.
Right, Maxwell. We have been warning the audience. We said that all this money printing would pop up somewhere, and we have, of course, seen the wealth gap explode over the past year. And here's some data showing how those who already own assets in a time of relentless money printing are the ones who are earning the most. Well, since beginning of pandemic, median sales price of U.S. homes has jumped by $50,000 to a record $370,000. Servicing debt each month is $100 more now than a year ago, as per Realtor.com. Calculation assumes 20% down payment, 30-year loan, and mortgage rate 50 basis points lower than in March 2020. Of course, this is the median sales price, so it's perhaps higher priced homes are coming on the market as people flee the cities, like wealthy people flee San Francisco and New York. But again, this is just demonstrating that those who hold the assets are benefiting the most.
Right. So you make the point about the actual money drops that they did, something like $2,500 or something versus the $50,000 in house appreciation, right? That's very starkly demonstrated the inequality here.
Right. Last year around this time, I believe it was $1,600 they gave most Americans. And then recently they gave every American, or close to every American, $1,400. So that's about $3,000 in total over the past year. Some families have more because some families have children and they got money. So just to put that into context, like on the one hand, that's like the headline grabbing thing. Everybody's like, wow, all these families are getting this money. Well, those that owned assets, as well as receiving all that free money, made a whole bunch more, $50,000 more in the year. I know just where we live, all of the house prices have gone up at least $50,000. You could look on Zillow, and on paper, it's all at $50,000. Of course, if everybody were trying to capture that gain, it would probably decline rapidly. But nevertheless, it's just showing you on paper, at least you could borrow against it. You don't need to sell that property. You could borrow. You have $50,000 more equity at your disposal to borrow against and buy the second homes, as we were covering in the last episode. You could buy more stocks. You could continue to run away from the bottom 80-90% of the population.
I mean, this is really a stark indication of this inequality in the economy. So the house is going up at a rate that's commensurate with the money supply increase, right? The 15 to 20% that the money supply is increasing. But because of the way the economy is set up here in the United States, that does not get reflected in wages, because when it comes to adjust wages, the government will say, well, there's only 1 or 2% inflation, so we're not going to adjust wages up more than 1 or 2%, because they don't include housing in their inflation calculation, not to the extent that it would be truly reflective of this incredible wealth and income gap that's engineered by the money printers and the banks and the politicians. And what we've been saying now for a long time is that the labor market should always try to tie wages to actual money supply growth and actual inflation. Had they been doing that since the 70s, the minimum wage in America would be $50 an hour just to keep up to where the true inflation number's been. And that would have achieved some kind of equality. But this joke about, well, inflation's at 2%, but the house prices are skyrocketing 15 to 20%. That's such an egregious and outrageous ripoff.
Well, we're going to go into the point that it's basically the messenger has been shot over and over for the past few decades, thousands of years. It's always that where does that phrase even comes from, to shoot the messenger? It was when, geopolitics in medieval times, like the messenger from one king would go to another king and say, deliver some bad news, we're going to start a war or whatever, and they'd shoot the messenger. Well, the same thing as the signals to the fiat empire it gets shot, right? The bond vigilantes, the gold bugs. We're going to go into the gold bug thing because the empire, Caesar, doesn't want to hear bad news, right? And because of that, you see the disintegration. We saw it in the end of the Roman Empire, and we see it now where people don't understand. It's hard when you lose the signals. It's hard to know what season it is, what time it is, what part of the cycle we're actually in. With the property market, I also must add that the actual volume of mortgages is down because banks are being stricter of who gets these, who gets to enjoy these low rates right now. They're being stricter in terms of your credit quality. So there are fewer homes on the market because of the moratoriums, and also because of the mortgages available are only available right now to very, very high credit worthy people.
Right. That's it's another a sad situation where, because the banks are getting so much free money from the government, they don't want to take even any risk on any small to medium-sized enterprise or anyone looking to buy a house. Because why take any risk at all if the government's just going to stuff trillions of dollars on your balance sheet, right? So it's another huge, disgusting destruction of the economy, essentially.
Right, and I think the official inflation numbers are somewhere around 1.2%. Again, like, it's hard to know. Is it the 15% increase in housing costs, which are a basic need? Is it the increase in education, which isn't necessarily urgent, but you have to get a college degree to get even basic jobs in America? Healthcare costs, like, which ones do you count? And if they only count some, and it's a gaslighting through manipulation, hedonic adjustment of these sort of data. Like, okay, house prices are up 15%, but they'll say hedonically, they'll buy a hamburger instead because hamburgers went down in price, or they'll buy, some electronic equipment from well, cars are going down in price. They did go down in price until recently. So they just hedonically adjust in increasingly bizarre ways. But I talked about, the geopolitics and geoeconomics and how empires throughout the centuries would shoot the messenger. And it was all, wars back then used to matter about how much gold you had, because you would go bankrupt when you started a war, and you would do everything to try to avoid a war. But that price signal of gold has been an important one for 5,000 years, right? It was an important signal about what the price of gold was doing in terms of how long that empire or that system had to hang around, especially post 1971. In the early days of 1971, Paul Volcker had to step in and try to, fight the gold bugs, because the gold bugs were a threat to the establishment of the US dollar as a world reserve currency when we went off the gold standard. But today, now, the likes of Bloomberg's Joe Wiesenthal is declaring gold bug macro is dead. I'm officially calling it. Gold bugs have had enough time to make their case. They failed. It's over. He does cheat a bit here because he shows the 10-year chart of gold. And so obviously the gold bull market started back in 2003 when Gordon Brown sold half of Britain's gold supply at the all-time 5,000-year low. So he's starting from 2011 when the price was very high, as you know. So the chart looks like from that 2011 high of around 1900, and it fell and then went back up. So in that time, he's saying, here's a chart of gold over the last 10 years. It's up about 10%. During this period, we've run large deficits the entire time. And in fact, over the last year, some of the biggest fiscal stimulus of all time. During this time, the size of the Fed's balance sheet rose to nearly $8 trillion from under $3 trillion. Not only has gold performed poorly, the dollar is still dominant.
Right. Well, that's only in dollar terms, right? So Joe is over at Bloomberg. It's a U.S. News service, and it's for a U.S. audience. But if you look at gold and just about any other currency around the world, it's doing fantastically well, particularly in currencies that are collapsing, like the Turkish lira. Obviously, gold is skyrocketing against all other, various other currencies. It's doing well. And even against the dollar, it's still maintaining to outpace the official inflation rate. So it's never stopped doing that. So hasn't never stopped doing what it's supposed to be doing, number one. Number two, the dollar is key, right? The dollar is world reserve currency, and the U.S. will do anything that they possibly can to avoid countries dropping the dollar from their mix of how they do global trade. And that would include an enormous amount of pressure on the bullion dealers and gold banks to do some hanky-panky with those numbers, has been proven over and over and over and over again, with many billions of fines being paid for manipulation.
Well, a few things. Joe Wiesenthal is, of course, that's how he gets engagement, is targeting for trolling certain very passionate communities. There's a goldbug community online. There's a Bitcoin community online, and he engages them by saying something outrageous about their ideology or position or philosophy. Then, we're talking about price signals failing, and they are through manipulation and brute force in some cases. During that time, he fails to mention, of course, that all his friends at JP Morgan and other banks have been fined hundreds of millions of dollars. Well, $1 billion just at the end of 2020. JP Morgan paid $1 billion fine for manipulating precious metals prices. Whether or not that kept it down, I hardly doubt it, but it certainly gaslit participants, investors in that community when prices don't act as they should, they believe. But it's also like the equivalent of what we're talking about, the hedonic adjustment. So he selects a time frame and says, look, it's only up 10%. Of course, if you scale back to when it was $250 back in 2003, so in 20 years, it's up, 600%. So it's, that's the same thing. That's the equivalent of what central banks do, is they try to reframe, move the graph of where you're looking to make you feel like actually things are better.
Right. Joe Wiesenthal and Bloomberg engage in pure sophistry. That's that's his job. Not unlike, let's say, a lawyer, for example, who might know their client is guilty, but their job is to engage in sophistry, professional, fallacious statements, but that they're professional liars, in effect. And so this is essentially what his job is there, to as you say, to attract engagement by making fallacious arguments. And that's sophistry, and that's what he does for a living.
So the price signals is what I'm saying is like that people used to be able to understand price signals. They used to indicate, what the next phase of a business cycle was going to be, how if the government had too much debt, the trillions and trillions and trillions of dollars, as he points out, should have driven gold higher. In the old days, in the 70s, in the 80s, and then even the 90s, you wouldn't have been able to rack up this much debt without either the bond vigilantes or the gold bugs basically claiming all the headlines with dramatic price moves and price signals that the news was forced to cover, and then thus caused the investors to look at the government. So they have succeeded, I believe, in destroying those price signals. And that's why people are going to Bitcoin, in my opinion.
Look outside the dollar, Joe. And we'll be back right after this, so don't go away. Welcome back to the Keiser Report. I'm Max Keiser. Time now to continue with our conversation with Wolf Richter of wolfstreet.com, a must-read website every day. Check it out. Wolf, welcome back.
My pleasure, Max.
Yeah, I wanted to pick up on something from our previous segment about inflation versus deflation and how we've got potentially an inflation being driven by things like chip shortages, or what we just recently saw in the Suez Canal, total blockage of the canal for 12 days. And the supply chains were interrupted mightily. And, people say, well, inflation is always a monetary event. That's a phrase you hear, and people accept that to be the story. But there is another side to this. If you have these shortages and disruptions and the supply chain crashes everywhere, you get a different kind of inflation, and it's just as pernicious and just as ugly, right, Wolf?
Yeah, the shortages have generally a temporary impact. But if they, like this Suez Canal thing, when it goes back on track, there'll be delays and they'll catch up eventually, and people will get manufacturers will get their parts. But when the psychology sets in that this is now a kind of a permanent condition that we need to expect higher prices, and that goes from suppliers all the way through to consumers, and the psychology indicates then that people are willing to pay higher prices and then actually turn out to be willing to pay higher prices. That's when price increases become unstoppable, and it becomes not a monetary thing, but a psychological thing. And there's a big psychological component of inflation. And when that starts kicking off, it's very hard to stop. When everybody is expecting price increases and it's building and it's building those price increases into the models, and consumers are willing to pay these higher prices every time. That's when inflation really takes off, and people stop trusting the currency. You have that in Argentina. They're trying to get rid of the currency as fast as they have down there, and which causes that this distrust in the currency causes major bouts of inflation. So you have a whole nother component there, and I think these shortages can trigger those kinds of things quite rapidly.
Anecdotally, when I see things like a Mario Brothers gaming console, the little handheld device from decades ago, piece of plastic essentially, selling for $600,000 as a collectible. People in these new NFTs comparing these artists to Leonardo da Vinci, and that the prices could surpass those of da Vinci. Anecdotally speaking, this to me suggests that we're in a crack-up boom. And that seems like what you're talking about. Psychologically, people are now just basically have gone insane.
The word I use is mania. And there's lots of terms for this. And in many places, that's exactly what we're looking at is some kind of mania where rationality has gone out the window, and now things are just going haywire left and right, essentially.
The bond market, of course, usually calls time. And the bond vigilantes were always there for decades, selling off the bond market when it looked like there needed to be some discipline imposed on the Fed and interest rates. But recently, the bond vigilantes have been euthanized by things like quantitative easing and other actions by the Fed. But in the first quarter of 2021, we had the worst bond market in many decades, I think going all the way back to 1980. So is the bond market reimposing itself on these markets? In other words, interest rates are starting to go up now. Is this for real or yet another head fake? Because when you listen to Janet Yellen and these other central bankers, they say we've got yield control, yield, management. We're going to buy everything, the 10, the 20, the 30-year bond. There's nothing we can't buy. But have they run out of ammunition? Is this the beginning of the collapse of the bond market, Wolf? Tell me it is.
Yeah, in theory, central banks can buy whatever they want to. I mean, that is something that we know. The Fed has discussed yield curve control, so buying longer-term bonds to bring down long-term yields in the fall last year, and decided not to do that. And now they're essentially letting long-term yields rise. They're saying it's a sign of economic growth and higher inflation expectations. So they're kind of supporting it, and they see this as a sign of victory for their policies. And also, I think the Fed is getting leery of all the manias out there, and rising long-term interest rates will tamp down on some of these. So I think that this is a minuscule little form of tightening that they allow to happen instead of doing real tightening via higher short-term interest rates and stopping the QE. Now, Japan and the ECB, they are on in Europe, so they're on another track, and they're trying to keep long-term yields low. But in the United States, that hasn't happened. So we've had, like you said, we've had a surge in long-term interest rates in the high-quality corporate sector and treasury yields. Now, junk bonds are entirely different, and they've had a banner quarter. But so the high-risk end, people are still chasing yield down there, but the high-quality bonds or treasury securities and high-grade corporates, they've had a horrible quarter, meaning rising yields. And, I don't know how far this can go now with the short-term yields being at zero, but at some point, they'll run into a ceiling. But for bondholders, this is a very tough situation now, because they're looking at much higher inflation rates, and the purchasing power of their 10, 15, or 20-year bonds is just getting crushed by inflation. So that's why bondholders now are worried about inflation, actually.
But you're suggesting that, as always, it's all a rhetoric and signaling about we're not worried about these rising rates, that they position it as a triumph in some way, but they can always come back. and print as many trillions as they need to go to yield curve management. They can buy the 30-year bond. Now, for all this to keep going, of course, it relies on coordination. All central banks around the world have to coordinate. None of them can break ranks and decide like, hey, we're gonna destroy this cartel and we're gonna kill the U.S. dollar and the U.S. Treasury market and make a killing doing it. And any central bank in the world would make many trillions of dollars if they broke from the U.S. dollar hegemony, and they would be the number one economy in the world within 6 months. But as long as the dollar is the lubricant that keeps all these central banks together in one hot tub of interest rate fraud, everything is continuing status quo. But so can that just continue on forever? Or is there any central bank in the world that is threatening to maybe take on the cartel and break away? What do you think?
Well, I think inflation will be the one thing that nobody wants. Yeah, there is a certain amount of inflation that everybody feels comfortable with, but when it gets to be higher, then the interests that are represented by the central banks are no longer being served, and the whole economy will suffer as well, asset holders. So when it comes to inflation getting close to the discomfort level or spiraling out of control, the central banks will start cracking down. And I'm convinced of that. I mean, especially the Fed, when you think about what it represents, it will not crush the asset holders by allowing inflation to go to 15% or something. And so I think that's one risk out there. However, if the tolerance for inflation is very high, that could allow inflation to spiral out of control, and they could keep buying long-term bonds. And the bondholders that were left are the central banks then. But I don't see that as a possibility. It's a real possibility because central banks are just too worried that when inflation gets out of whack, that their primary clientele is going to get hurt badly by inflation. And I think that's an issue that they're going to have to face.
Well, the one standout there would be China, obviously. So we've had a period of globalization. We had the relationship where China was exporting all the goods and they were importing lots of dollars, and the quid pro quo was continuing on. With China now the sole real true winner of the post-COVID global economy, do you think they would break away and say, you know what, we're not going to keep this U.S. economy afloat anymore. We're going to go our own way. And you see a lot of geopolitically, there's a lot of skirmishes out there, hot spots as they're called. People are scrambling jets here and there. Is this tension brewing? And are the markets adequately discounting for that? Or have the markets gone to sleep in the face of what could be an interesting geopolitical contest? Wolf.
The markets have gone to sleep about a lot of risks, and that being one of them. China, as the world's largest exporter, has benefited hugely from the stimulus paid in the United States and other countries where consumers have bought massive amounts of durable goods that were manufactured in China or whose components were manufactured in China. So their manufacturing boom has taken off over there. The consumer demand has come back in China too, and they have a housing bubble like everybody else, and China is their word too. They're trying to play this game. They cannot afford to lose their exports to the developed world like the United States and Europe. So they have to be able to export to these countries. That's part of their economy, and at the same time, they've got their own social issues they've got to track. And so this is very complex, what they're trying to play there and keeping the economy humming over there, keeping the people from revolting, and at the same time dealing with all the international pressures. And, that I assume, optimist that I am, that nobody's going to make a huge mistake that can't be reversed. That they're just playing on the margin with issues, and but the tension with China will stay with us for a long time. But neither side can afford to completely rupture that relationship. It's just going to be just a fiasco like nobody can even imagine if that happened.
Quick question. The work from home era, do you think it's permanent or go back to the way it was?
No, it's not going back to the way it was. We're seeing more and more companies going to a hybrid system where part of the time people can work at home and part of the time they have to be at the office. That itself will have a huge impact. I think that is one of the major changes coming, maybe the most important change coming out of the pandemic.
All right, Wolf Richter from wolfstreet.com. Thanks for being on the Keiser Report.
Thanks for having me, Max.
And that's going to do it for this edition of Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank our guest, Wolf Richter of wolfstreet.com. Until next time, bye, y'all.